This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. You're listening to episode 146. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. We are less than 1 week away from the SNN Network Australia virtual event. The full agenda is now live on the event website, which you can see at australia.snn.network. Be sure to join us on November 9th and 10th, 2020 U.S. Pacific time and 10th and 11th Australian East Coast time. We have a fantastic lineup of speakers, panels, and presenting companies. So for more information, please visit australia.snn.network. And to register for the event, please click the button register now. I look forward to seeing you all virtually at the SNN Network Australia virtual event. We have an A-plus guest list on the SNN Podcast Network this week, starting with In the Market Trenches with Gary Reeby and Eric Fure. Our hosts welcome fellow podcaster, author, and friend of the SNN Podcast Network, Tobias Carlisle. He'll be joining the boys to discuss, what else? A war story. It's in the market trenches. It's war story time, as well as the recently announced Roundhill Acquirers Deep Value ETF, symbol DEEP, DEEP on the NYSE, which will target deeply undervalued small and microcap companies. You do not want to miss out on this episode, which you can hear on Apple, Spotify, YouTube, or Podbean at inthemarkettrenches.podbean.com. For the next episode of Avoiding the Crowd with Maj Suedan, we're continuing the conversation that we started last week on dark stocks. In that episode, Maj discussed an investing experience at a company that not only was a microcap, but it also happened to be a dark stock. So we thought it'd be really fun to invite on a guest who has vast experience investing in dark stocks, and that's Dan Shum of No Name Stocks. I know I said you won't want to miss the In the Market Trenches episode, but you definitely don't want to miss this episode either. There is so much information about dark stocks and investing in dark stocks. It's a gem. So go and check it out on Apple, Spotify, YouTube, or Podbean at avoidingthecrowd.podbean.com. And we also have a very fun episode in store for you on the Investors Roundtable. This week's topic is trying to define what are compounders and how do we find them. There's been a thread on Twitter going around on a firm claiming to have created the term, and I figured we should do an episode to demonstrate that a definition of compounder may not be as straightforward as you might think. You can watch this episode on the SNN Network YouTube channel at www.youtube.com/SNNWire. Now, for this episode of the Planet MicroCap Podcast, I spoke with Harris Kupperman. He is the founder and CIO of Praetorian Capital and chief adventurer of the Adventures in Capitalism blog. Kuppy, as an investor, has always been looking for cheap stuff, something I think most of us as investors are also looking to accomplish. What we discuss in our interview is how he's gone about not only finding the cheap stuff, but then his game plan on making money on those bets. We cover his background, investing philosophy, event-driven investing, shipping, tankers, Bitcoin, just so much fun, just a solid conversation on investing. So thank you again for tuning in to episode 146 of the Planet MicroCap Podcast. And please enjoy my interview with Harris Kupperman. Welcome back, everybody, to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and joining me today is a very special guest. I mean, all our guests are special, but you know what? I want to make him feel special. So we got Harris Kupperman joining me right now. He is the chief adventurer at Adventures in Capitalism, as well as the founder and CIO of Praetorian Capital. Harris, or Kuppy, what's going on, man?
Hey, thanks for having me on.
Great. It's great to have you. What would you prefer? Me, I could do Harris. We could do Kuppy. We could do man. I mean, whatever you want, man.
Everyone alive calls me Kuppy except my mom and my wife. So let's go with Kuppy.
Fair enough. All right, we'll go with Kuppy. All right, dude. Well, I'd love to start off with your background. Where would you say your passion for investing began, and then I'm sure we'll go off on many, many tangents from there.
Probably. I went to boarding school in Phillips Andover, and this was during the Asian crisis in '97. And I just remember watching on TV in the rec room all these guys in suits running around the NYSE floor, panicked and losing tons of money. And I just got to thinking that if they're losing money, someone's got to be making a lot of money. And I figured I might as well figure out how to make some of that money. And I opened a brokerage account with a few $1,000s and just started playing the game. That's kind of how I started.
Well, then how'd you figure out who was making the money?
It wasn't me the first 2 years. No, it was actually really hard. Back then, it was what, $10, $15 each trade. And, I didn't have a lot of money in my account, so I was trading like 50 shares. And you're just giving up too much on the way in, too much on the way out. I really thought that the money was made day trading because that's what the guys were trying to sell you. Here's a day trading class and do this. And it just didn't work the way I thought it would. And so I lost some money. And that summer, I went and cleaned pools the whole summer. And I saved about $6,000 working real hard in the sun. And I tried it again, except for this time I used my brain more and started looking at, what companies were cheap and learning about valuation and really just learning how the world worked. And it kind of gave me a second chance to play the game. And this time I actually made some money.
Good stuff. I mean, what was that first book, that first inspiration on, maybe I should look at value investing, or, who's a couple smart guys that they made some money. I should go read what they're writing.
Honestly, I just stared at the screen. I sat there all damn day and just stared at the screen, and I started looking at patterns. I started noticing that certain things would repeat themselves. And I wouldn't tell you I was a day trader because I was kind of doing more like multi-week swings, but I noticed some patterns that seemed to work, and I started playing those patterns. And surprisingly, I was making good money after a while. Really basic stuff. Like IPO, you have like 3-day, 5-day consolidation. It breaks a new high, and usually just keep going, or it breaks a new low. And this is during the tech bubble, so it would just keep trending lower forever. The big epiphany for me that really got me in the game was you'd have these companies that would IPO, and they'd IPO at like $20, and be a 2 million share IPO, but it'd be tons of shares, millions and millions of shares. But they'd IPO this little tiny float, and then the insiders would walk it up. The insiders being the venture capitalists, they'd walk this thing up from $20 to $200 the first day, and then it'd bring all these retail guys in, and this thing would be a multi-billion-dollar company that had like negligible revenue and no path to profitability. And if you shorted them, you get ran over. But what happened is that 6 months after the IPO, you'd have the unlock. And what I realized is that the VC guys, they'd have a cost basis of a nickel a share. They really didn't care what price they got. They just had millions of shares to sell. And the day of the unlock, the thing would waterfall, and would just keep waterfalling for weeks. And so I got myself a list of all the unlocks. And back then, there's no service that had this sort of list. You had to go through all the SEC filings, just build your own list. But I built this list, and I started shorting these companies. If they had put options, I'd buy puts. But I turned a couple $1,000s into a few $100,000 during the summer and fall of 2000. That's really what got me in this game, is that I'd made enough money that I could make a lot of mistakes and still stay in the game. But that was kind of what changed it for me, trying to scrape out a few $100s here and there to me actually being able to sit down and learn about value investing. Because I came to realize that I found this weird niche, but then it ended. I didn't know what I'd do next, and what I did next was find cheap companies growing fast. It was like another niche that I found I could harvest.
Right. Well, you got yourself to a point where you're comfortable. Like, okay, I got a couple bucks now. I'm feeling comfortable enough where I can support myself, and now I can take a couple bets on some high risk, high reward type stuff.
Right. Well, it just came down to the fact that there were no more $200 stocks that were worthless to short. It got to be like 2001, and it was all picked over. These things were all going bust, and so I said I got to go find a new trick. And I guess the new trick for me, I learned some value investing. I started reading and learning, but then what happened is what's called September 11th happened, and everything just collapsed. And I was watching this stuff collapse, and I was caught long that day, and it was a pretty terrible day, in terms of my portfolio. But when the markets reopened, I started to collapse. I saw these hotel stocks that are just on the floor, and it wasn't hard to look at these things and say, these things trade at like 10 cents the dollar of replacement cost. Yes, they have a lot of debt. Yes, they have zero occupancy. Remember, everyone stopped flying, just like this COVID. Everyone stopped traveling, everyone stopped flying. And I found these two companies that had a lot of exposure in Washington, D.C. and Manhattan, which I guess are the two places most exposed if the terrorists can attack again. And they were small portfolios of companies. I mean, even before the attacks, they were only 200-300 million market cap, but they collapsed down to like 20 million market cap. They were this little tiny equity sliver on a lot of debt. And, I just knew that eventually the politicians would, need to go back to DC, and the lobbyists would, and people would go back to Manhattan. And it was just a question of, could these guys outlast it and survive long enough? And I ended up making pretty good friends with some of the ladies who were running the front desks at these two companies. Just built this big spreadsheet with phone numbers. I'd call these girls up and, how's occupancy this month? What's going on next month? What are you seeing? And I'd send some flowers and some chocolates. I was charming in college. And, I eventually saw the inflection. I went all in, and, it was my first real value investment, and it was spectacularly good. In retrospect, you're not supposed to bet, more than 100% of your nut on two semi-bankrupt hotel stocks, but I didn't know any better. I was like 22. All right. But anyway, it was kind of like another giant score, and I said, to hell with being a trader, and to hell with trying to find these repeating patterns. They're great and all, and if you find when you can harvest it, but this value thing, it got me hooked because it's very empirical, it's very logical, and it just made perfect sense to me. You buy stuff really, really cheap, and you wait, and it's kind of what really got me going in the direction I am now.
Gotcha. I thought you were going to be like, to hell with this day trading stuff. I'm going to retire. Well, why not? Let's go to the beach.
I'm enjoying myself because remember, I'm like a sophomore in college. I'm making more money than my dad, and he was a doctor, and he went to university for like 10, 15 years as a doctor, and I'm like 3 terms in, and I'm making more money than him. And I'm just saying, Dad, why do I need to be in school? Like, I'm wasting my time here, Wait, what did he say to that? Because that must have been a hilarious, like him finding out you're making more than him. He's like, wait, what? I'm over here. I'm cutting people open and risking my neck for all this. And you just did a couple trades, and that conversation must have been hilarious. Yeah, well, I told him I was dropping out of college because, college is during the day and I need to be in front of my screens during the day. And he kind of pleaded with me, and then he kind of told me he's going to kill me. And we finally settled on the fact that I'd complete college, but I'd basically choose what my major was. So I got a history degree, which I was kind of passionate. I was going for Roman history, which is something I was passionate about, classics. And then I started going to night school, and all the Roman history professors are like 90 years old, and they're all in bed at that time. So I ended up getting my major in Latin American Revolutionary history.
Oh, that's cool.
Interesting also.
Yeah, that's super. Did you read, Sarmiento? Did you read any of that? I lived in Argentina for 4 months, and we read a few Latin American history books. It was more.
I barely remember college. I'll be honest.
Fair enough. Wait, where'd you go?
What was it? Like Castles of Solitude? I don't remember all that stuff. I went to Tulane in New Orleans.
Oh, that's fun. Oh, of course you remember what happened.
Mardi Gras and fraternity. And remember, I was full-time investing and trading during the day, and then I had a pretty active social schedule at night. So I really didn't have time for school. I kind of phoned it in and got mostly C's and D's. And
do you have a degree? I mean, it should be. It's on the wall somewhere. Like, you got it.
We just moved into our new office about a month and a half ago. I haven't unpacked anything. I actually started collecting stock certificates about 10 years ago. And
Oh, that's awesome.
Stock certificates. And there's a bunch of them actually in my condo up on the wall, and the rest of them are in storage. One of these weekends, I'm going to go pick them out and put them up on the walls. We do this again in a year. You'll see a bunch of certificates behind me.
My dad does the same thing. He's got a whole bunch of certificates. They're not up on the walls yet, but we have a whole bunch just kind of all over the place. They're really cool.
Like the original Panama Canal, the French Panama Canal bonds, and I got like Confederate war bonds. I got all sorts of cool stuff.
Oh, that's awesome. Wait, and I have to ask, what fraternity were you in?
Oh, I was ZBT.
Are you ZBT? Oh, okay. I was A Pi. So
okay.
I Kupperman. I figured we might cross paths at that point. You never know. You never know. Well, all right. So Kuppy, let's fill in the gap, man. All right. So you did pretty well as a college student. You're making a couple bucks. Fill in the gap for me. So how do we get from college student making a couple bucks to founding Praetorian Capital?
Well, it was actually kind of easy because all my dad's golf buddies kept calling me up for stock tips. And they're just like, what are you buying today? What are you doing? And they started making a lot of money on stock tips. And my senior year of college, they came to me and they said, hey, here's, 50 grand, here's 25 grand. You just take the money. And I didn't really know what I was doing because I was, 21. And so I'm just like, yeah, I'll take it. And I looked on the internet and I found some partnership documents. And I'm sure I did it totally wrong, but thankfully everyone made money, so I didn't get sued. But I changed the names and the dates, and we were off and running with a hedge fund. And then about 2 years later, I got my first, pretty large New York client, and he looked at my documents and he kind of laughed at me. And he said, you have to go with this law firm. And I went with one of the really expensive law firms, and they redid everything and, really professionalized everything. But I was a hedge fund by that time. I had great numbers, and in the end, no one invested because of your documents. They invested the numbers. And I started my fund January of 2003. We were just coming out of that little mini recession in 2002. And I was a small cap growth guy. And I was buying a lot of these small cap growth companies that are mainly consumer products. And, a lot of these things probably shouldn't have been public. They're like legacy weird assets. But I was buying a lot of things that were growing 30 to 50% a year. And I was paying like 3 times earnings. A lot of them had minimal debt and high insider ownership. And these things just end up being 10 baggers, It was so easy. They just gave money away that year. And then for the next few years. And from there, I was a really early believer in the commodity boom and what was happening in China. So we got ourselves into copper and tankers and gold and coking coal, and anything that China needed. I mean, the story that I always told people is go through a list of what China needs, and next year they need more. And we were just going to own all of it. And between that and the consumer products companies I had, we just put together a huge year, back to back to back, huge years. And so, I never really raised a lot of money. I wasn't really that good at it. I guess, no one gives money to a guy in his early 20s. but we just had so much from profits from compounding, every year after year, that ended up being a decently successful fund. And, it was a great experience, actually.
Oh, very cool. So catch us up to today. I mean, Praetorian's still around. You started this blog, Adventures in Capitalism. So when did you start the blog and why?
So let's go back in time a little. In 2008, I owned a lot of smaller companies, a lot of small cap stocks. And when the world ends in 2008 and 9, of course, large caps drop by half, your small ones drop by more. And it kind of turned me off to the whole hedge fund thing because a bunch of guys were redeeming. They wanted their money back. The world was ending, whatever's happening. And I was saying, I want to buy. This is like the moment you got to be buying. And instead, they're saying, no, Kuppy, you got to be selling. And I'm just saying, this makes no sense. And so I kind of put the hedge fund into runoff. It kind of just turned me off the whole hedge fund thing. And I'd made a decent chunk of money and I didn't really need a job or anything. And so I went off and did my own thing for a while. I started a company, which I'd rather not talk about, but I kind of did my own thing for a while. And then in 2018, I got myself into trouble with a company called AMIA, which was, it owned the airplane program in Canada. They were undervalued, and the management team was just looting the company. They were just taking all value away. and I owned a lot of it, and but not enough to influence the outcome. And I said to myself, as an investor, you could either own a couple shares and you just sell and walk away, or you can own enough shares that you can, threaten them that you're going to hire lawyers, you're going to go to 19.9. You're in this like netherworld where you own too many shares really to sell because, one, the slippage on the way out, and two, I see the value there, but I couldn't solve my own problem. And it just made me think that I ought to restart my hedge fund because it gives you that sort of firepower to fight back. I'm not an activist. I don't want to be an activist. I actually find that a lot of people who buy into a failing company looking for a fight, often misunderstand the situation. They think the problem is management, and many times it might be management actually is the problem. But I think just as many times it's just a bad business, and management's doing their best. And the problem isn't management; it's just a bad business. And people think, you move this thing around, change that thing, and it just doesn't work the way they hope. Plus, they spend millions of dollars of their own money, fighting against management who spends millions of dollars of their money fighting back to keep their jobs. It just seems like a terrible way to make money. So I never set out to be an activist. I want to be, a constructionist. I want to help. But at the same time, I don't tend to ever be a victim either. And if management is going to go and loot my company, I want to fight back. So in the end, that's why I relaunched Praetorian. And when we relaunched January of last year.
Gotcha. So,
today.
now we're definitely all caught up. So, in telling your story here, has anything changed in terms of your investing style and approach, or you're still consistently looking for small cap value, or you kind of look all over the place, or change up your strategy?
Yes and no. At the core of what I do, I want to find small companies that are going to become big. It's really great when you find one of these because you don't have to really think very hard or do much year after year. They just grow and the valuation compounds. And when they hit a certain threshold for size, suddenly they join the ETFs and then they just go parabolic. Unfortunately, anything with any sort of growth right now trades at an insane valuation. And I just can't find anything that interests me. And so instead, I've been doing other things. You have to kind of reinvent yourself. And right now, I'm doing a lot more inflection investing. You've heard of global macro. I like to talk. Global macro is kind of like interest rates and currencies. I like to think of global micro. These are all the small little markets that no one really talks about. It's little sectors, it's little niche things that have been forgotten. Often cyclical. Sometimes you just have a catalyst that takes a sleepy sector and moves it. But if you can follow these sectors and identify when the inflection is happening, you can make a surprising amount of money because a lot of these stocks are valued as if they're pretty much dead, maybe because they are. And if anything goes right in any possible way, you have huge multiple expansion, you have huge appreciation. So I've been doing a lot more of that. In the end, you have to take what the market gives you. And right now, the market is very ETF focused and it's very passive focused and it's very quantitative focused. And all those strategies kind of ignore companies that have earnings volatility, whether it's quarterly volatility or cyclicality or any sort of volatility. Computers can't model it, and if the computers can't model it, it has a low valuation, which means that then the ETFs don't buy it. And so you have these orphan securities all over the place, and I've been spending my time on that sort of stuff just to see the potential, I guess. Gotcha.
All right. Well, this actually kind of segues into some of the things I wanted to talk to you about because, I went on Adventures in Capitalism. I've been following you on Twitter for a long time as well. And the one thing you've been talking about a lot, well, you just closed the thread on it. So I don't know if you're still looking at this or not, but that has to do with event-driven investing, and this idea of inflection point investing. So, are you still looking for opportunities like that? And if yes, what are some of your criteria?
In terms of inflection or event-driven? The third thing I do is we take some of our...
Is there a difference? That's an interesting question. Is there a difference between inflection point and event-driven?
So like an inflection investment is something like St. Joe, which we'll talk about in a bit, or tankers, which I'm sure you're going to ask me about.
No.
That's something you put on and you have a multi-quarter thesis and it plays out or doesn't play out. I think of event-driven as being something that's very truncated in terms of time. It's a couple of weeks, maybe a month or two, but you see an event, whether it's like a spin-off or a secondary offering or rights offering, it's some discrete event. and you have a duration of that event, and either it works or it doesn't work. You have to stop in place, which may take you out of the event earlier, but it's a very discrete event, and it's usually tied to some sort of corporate action. And so that's event-driven to me. Inflection, some of these can inflect and keep going for years. I think it was sort of different in terms of timeline.
Gotcha. Yeah, no, because like when I think of it, and I agree completely with what you just said, because when I think of inflection point, you think of not just what could be an inflection point for the company, but usually when you ask a micro cap and say, hey, what's an inflection point that's coming up, they usually have some kind of macro thing, and that's what might influence an event driven action for that company, that might be coming up, whether it's I won't name certain sectors, but especially, all right, let's say especially right now with EV or anything like that. If something happens, for instance, in that sector, if they have any kind of exposure, that could be quote unquote an inflection point for that company sometimes. But that's kind of how I see it.
Yeah. I don't know. I think of event-driven. I mean, let's talk about an event-driven trade I did quite recently. There's a company called Dillard's. It's basically JCPenney 2.0, or I guess if Sears was 1.0, JCPenney's 2.0, Dillard's is 3.0. It's a failing department store chain, okay? It's got a decent balance sheet, and it's got some property assets. But I wasn't buying a dying department store chain. It's not really how you make money. What interests me is that there's more shares short than there are in the float, and the company's actively buying back shares. So you have a clear event where, at some point, it probably going to squeeze higher, because if the company keeps buying into shares and there's not a lot of shares outstanding anyway in the float, it sort of solves itself because people lose to borrow. And I've been watching it for a while, but when the borrow rate spiked from like 8, 9, 12%, whatever, and it got into the 80 to 100, I just knew something was happening. I bought a lot of it. And about 3 weeks later, a month later, I bought mine about 28, and I sold mine about 41. I wrote about it on my blog, Adventures in Capitalism. It was about like a 1 month trade to make 40%. And I guess I should have held on to it, got all the way to 60, but I would sell too soon. But those are one of these clear things where you're risking very little, because the company's there using their revolver to buy back stock. They were buying back stock during Q2 when the world was kind of ending. So things are incrementally better as COVID abates and the world starts opening up. So if they were using their revolver back then when they were losing money, they're probably still using the revolver. So that they were sitting there in the high 20s buying back stocks, you got this floor underneath you, and that they're going to cancel the shares when they're buying back, so it's going to squeeze. And there's one of these sort of layup trades you get to see every once in a while. But that's kind of how I think of an event-driven thing.
Gotcha. Hey, a quick tangent. I mean, how have you been playing this COVID market right now? I mean, we, ever since everything happened since March, what's been the things that you've been seeing? Where have you been finding value?
Well, it's value everywhere. I mean, there's a period in March where everything was cheap, like truly cheap. Even great businesses were cheap. I mean, I wrote on my blog that the day of the bottom, I basically wrote a blog post and I said, if you're not buying now, like, when are you ever going to be buying? And I know people sent me this hate mail. They're like, Kuppy, you don't get it. The world's ending. We're all going to die. And I'm like, it looks like a bad cold. Like, we're all going to live. And it turned out to be the absolute bottom. And, I was 150 long that Monday. And I pretty much rode it 150 all the way up until 6 weeks ago. I just stayed long. I cycled through different sectors, but I just stayed long because I have this mental construct I call Project Zimbabwe, which basically says that the Federal Reserve is going to print money kind of like they did in Zimbabwe. And I visited Zimbabwe in 2010, and I was there on a day where the national airline went out of business. We actually had to hitchhike our way home into Zambia, and I went to visit the stock exchange, and the power went out. There was no food on the streets. There was nothing in the restaurants. The country stopped. Yet the stock market tripled that day. And so it kind of, in my mind, told me that you don't need a functioning economy. You don't need, Venezuela doesn't have toilet paper if the market goes up every day. You don't need any of these functioning things so they print enough money. And I don't think we're going to do Zimbabwe here in the United States, but we're going to do Zimbabwe light. And I think the stock market's going to keep going up. And I think there's only two postures right now, which are very long and incredibly long. And there'll be some shakeouts that are terrifying, and they'll try to shake your conviction, especially around the election that degrossed quite a lot. But for the most part, you just want to be really, really long. And so knowing that, I just every day show up and say, what's the cheapest thing I can buy? And I cycle assets.
Gotcha.
I want to be long.
Gotcha. All right. So, I mean, I can already hear my audience being like, well, ask him what's the cheapest stuff that he's seeing right now. But you know what? It sounds like it changes every day.
Well, I want to
not every day, but you know what I'm trying to say.
Yeah, but I don't trade around that much. I have an event-driven book, which is a few percent of our capital, which we move around a lot. It takes a lot of energy, but the returns are very high. But the vast majority of what I'm long, I've been long for months and months. I think the cheapest thing on the screen right now is a company called St. Joe. It's our largest position. I want to be long inflation. I think if you print enough money, eventually get inflation. Except for I think the Federal Reserve will manipulate the bond market to keep interest rates low. So you have an inflationary market with low interest rates. You want to be long property. I also think there's going to be a kind of resurgence repeatedly of kind of chaos. I call it the chaos. But you can have riots and things will go quiet again. There's something stupid will happen. There'll be more riots. You have a lot of very high tax states that are going bankrupt. And then you have Florida, which is a zero income tax state. And we have net migration every year here. And I think the pace of migration will accelerate now that work from home is a real thing. And you don't have to go into you don't have to go into Manhattan to a 40-story office building to do your job. So why would you ever live in New Jersey or Connecticut when you could just come to Florida? And, besides, the Panhandle is one of the most beautiful places in the United States. It reminds me a lot of the Hamptons. I'm from Long Island originally, and I remember these were like potato fields when I was a kid, and they ended up becoming like 20-acre horse mansions and horse farms and mansions. And the guys who own those potato fields made a fortune. And I see the same thing happening with St. Joe, where they are the largest owner of, they own 175,000 acres in the Florida Panhandle, most of its coastline. I just think it's a stock that probably should be trading for a few $100s today. And I think it ultimately trades higher from there. It's the most undervalued stock. So you ask, if I see this, why does no one else see this? And the real issue is that for the very longest time, nothing was happening. They owned land. There was really no cash flow. They'd sell off some acres each year to make payroll, cover SG&A. And so the thing, was kind of shrinking over time in terms of selling acres to pay management salaries. And they brought in a new CEO who said this is not sustainable. And he kind of said, how do we create recurring cash flow? And over the last few years, he's created a whole lot of recurring cash flow, actually. And as they sell off acres, they're selling lots for home sites. You're using the capital to reinvest in everything that happens when you bring thousands of people a year to property you own. That's one of these weird things where, if you look at like a Lennar, they'll put down a couple hundred units of multi-fam or single fam, whatever they do. And then they go, 100 miles down the road and they do it again. If you own 175,000 mostly contiguous acres, if you take some acres where there's nothing happening, you build multifamily, you build housing, apartments, or anything you build, well, everything around it now needs a grocery store, it needs a CVS, it needs a Starbucks, and then you get to build all this other super high return on capital stuff and lease it out, and then resell it or keep it. So every time they build something on their property, they're adding another, all the stuff that's around it, these acres that everyone says, oh, they're worthless acres, those become very valuable. There's suddenly people there. And you have this flywheel that just keeps spinning faster. In the end, I think it's going to grow 30 to 50% a year. I think I'm coming into it at a single-digit multiple on cash flow. And I don't know why you'd ever buy a SaaS stock, because here you could buy something at like 8-10 times 2022 cash flow, and you're picking up $100 plus a share of land for free. And it's growing really fast, 30 to 50% a year. I don't know. This is my biggest position. It hits every macro or micro trend I see. And, I'm structuring long inflation. I don't know why you need to own gold. You can own this instead. I actually swapped my gold out for Joe.
Yeah. No, what's interesting is we did a show on, or we did an episode on the Investors Roundtable. It's another show that I host. We were talking about mass migration, and kind of moving all, especially I was griping mostly because I live in Los Angeles and I'm just like, why the hell am I here anymore? And just everything. my wife and I asked that we have a lot of family around here. We have a newborn. So that's like the easy answer. But at the same time, we're just like, everything's so expensive, like, and there's, you can go and do what you do. I mean, I could do what I do anywhere, I just need good internet. What?
Well, I'm in Florida. It's great. I have internet here, and I can do something anywhere, but I love it here. I live in South Beach. It's great.
Yeah. I mean, what do you think? Should I come to Florida? I mean, I've been thinking about, I've been pitching Florida a little bit to my wife, just like, hey, it's close to the Caribbean, we can, there's a couple hurricanes. It's not a big deal. Like, it's bad. Yeah. It's for a couple days, and then you go surf Miami Beach. It's all offshore and it's beautiful.
Come check it out. It's really a great place. And what's interesting about Florida is everyone focuses on South Florida because that's where most of the population is. But it's a really big state, and it's a very varied state. It's really 3 states. You have South Florida, which is almost 4 states. You have South Florida, which is its own thing. You have the Florida Keys, which everyone always forgets about, but they're their own thing. You have Central Florida, which is really its own thing. And then you have the Panhandle, which is really Southern Alabama. And so you have different cultures, different regions. It's very varied and different. And I'd say go find the one that's right for you.
Absolutely. All right. So let's get back to investing a little bit. So as you alluded to, I got to ask about shipping and tankers. That's, I don't know if it's a claim to fame, but you've talked about it a lot. You've had exposure to it. So, I mean, are we still looking at shipping and tankers, or, what's your thought process there?
I'm still long tankers. I think it's actually going quite well. I'm a bit frustrated because I haven't made any money, but I haven't lost any money either. I mean, the whole point of inflection investing is you come in there with your position right at the inflection. And if you look at when I bought my tankers in Q1 of 2019, I basically bought the absolute bottom of a 10-year bear market. And I got the exact bottom. And after 10 years of losing money, they basically had 6 consecutive quarters with quite a lot of profits. Net asset values of these companies grew because they retained capital. They sold some older vessels on spikes. They locked in some charters. They did some smart things. They got some dividends along the way. The thesis is actually playing out more or less as I expected it to. You have IMO 2020 and you have IMO 2030 as gating functions, which are taking older tonnage off the water at the same time that there's a real dearth of new ordering because no one knows what new regulations are going to look like. I think there's a real case to be made that it's going to be hard to order new vessels going forward because a tanker lasts 20 to 25 years, and I don't know if they're going to be using ammonia. I don't know if they're going to be using solar-powered, wind-powered, nuclear, LPG, LNG. If you don't know what the propulsion source will be going forward in 15 years, how can you make a 25-year investment? Because it's going to be obsoleted before you recoup your capital. And so I think you have a lot of things working very well for tankers. This year is actually the most profitable year in 10 years, 12 years for tankers. I'm somewhat baffled that tankers trade at the prices they do, given how much money they've made. And, I feel like the whole world is so focused on, this week's charter rates, which quite frankly are terrible. And they're focused on this week's charter rates, and they're not really looking at, what the full year has looked like for the past 12 months. The end is a cyclical industry. Summer's always terrible. I assume this winter will be weaker than last winter, though probably better than the prior winter. You have a lot of fuel just because of COVID. Demand's down because of COVID. That's going to eventually lead to scrapping. But looking at forward another 6 to 12 months, the United States was producing 14 million barrels of oil before COVID started. We'll probably be somewhere in the 9 to 10 range when COVID is finally ending. And we're going to be importing, let's call it 4 to 5 million incremental barrels because demand's going to snap back and we're all going to be flying again. And when demand snaps back, where's those 5 million barrels going to come from? You start looking around the globe. Canada has the same shale problems, high decline rates that we do. Plus they have pipeline issues. Mexico's in decline. Venezuela doesn't really produce oil anymore. Guyana's up a little. Brazil's up a little. West Africa's a mess. Libya has no government. You start looking around the globe and you go, it's all coming from the Middle East, and those are super long hauls. And so, yeah, I'm bullish tankers. I'd like to add a lot more. I still have a lot. when it popped, I sold some. Just it's kind of a risk thing, when you have a position that's oversized position, it doubles. It gets to be way too big in your portfolio. At one point, tankers were almost 60% of my fund. You have to cut it back, and it's being disciplined is hard because when it's going really well, you say, why am I selling this thing that goes up every day? But then you kind of look at it today and you go, thank God I sold some. But I've added some back on the way back down. I'm waiting for a moment to really step in and add size because I believe in this trade.
Gotcha. I mean, I remember, I know in like the microcap space, it's probably the most volatile sector potentially in the microcap space, huge trading volumes, always very liquid. So I was always curious as to, looking at the underlying business and seeing what's real. I mean, in micros, it's, you listen to the presentations and it's, all right, we got 6 tankers, we got 5 tankers. I don't know. Do you look at the microcap tanker area as well, or do you kind of just look all over the place? Just whatever is good or quality.
Yeah, I'm looking for quality. I mean, in the end, tankers are a commodity product. Okay, so it's not so much like this tanker's different from this tanker. They're all kind of the same. You might have a view that I want to have scrubbers, or I don't want to have scrubbers, or I like older tonnage, or new tonnage, or eco. I mean, you can kind of choose where you want to be, or you can just take a view that I'm going to play it in basket, which is what I've been doing personally. Then it comes down to management. I want to work with people that are actual, shepherds my capital and will treat it well and not just steal all the money, which shipping is notorious for. But in the end, I want to buy that steel on the water for the cheapest price. I want to, you build a big spreadsheet that tracks all the shipping companies, and let's go buy the cheapest steel I can with the best management team I can. And that's kind of my goal. And I'll move around in the cycle. Maybe I'll go to product versus clean versus dirty. I'll pivot around based on where I see the trends and the valuation. But in the end, this is just value investing. If tanker rates go up, they all go up. If tanker rates go down, they all go down. Right now, my only tanker position really is a company called TK Tankers. They very well run. They locked in a third of their fleet when things were good. And they're actually doing quite well while everyone else isn't. And it's funny, they've actually been penalized worse than a lot of the guys that are suffering right now. And meanwhile, they paid off a lot of their debt when things were good as well. And because their fleet is a little older, you actually get a lot more deadweight tons on the water for the enterprise value, which is always attractive too, assuming you think things inflect in the next year or two as opposed to 10 years out. If you don't own tankers, you think it's going to be good 10 years out anyway. So in a way, you kind of want to own the guy that's in the 12 to 15-year-old fleet. It gives you enough runway to see your thesis play out, but you're not buying such a young vessel that you get less leverage. Anyway, I own a lot of that. I own a lot of a company called Praetorian, which is a very large gas carrier. Propane demands in Asia is just going parabolic right now, and they have to get it from somewhere, and they're mostly getting it from the United States. And those are super long hauls, and actually, VLGC rates are doing quite well right now. And oddly, Dorian has dropped with the other tanker stocks where it's just being lumped in. And I think it's a mistake because Dorian's actually making quite a lot of money right now.
Gotcha. All right. So
it's about 2 times cash flow and about 1/3 of net asset value.
Wow. So I want to switch gears a little bit because I want to talk about another topic that you've talked about recently on Twitter and I think in your blog as well, and that's your exposure to Bitcoin. So talk to me. Let's hear your thesis, man. Like what have you found so interesting about Bitcoin recently?
So I'm not one of those Bitcoin bros that think it's going to revolutionize.
What? Come on, dude. Let's go. Come on. I was really hoping a Bitcoin bro out right now.
Worthless. It's just bits in the sky. It's functionally worthless. It's a giant Ponzi scheme. It's kind of like an evolutionary dead end to nowhere. There's going to be the blockchain is real, and there'll be another blockchain that becomes the one that everyone wants. At the same time, I recognize a good Ponzi scheme when I see it, and you go on Twitter, you see how many people are pumping it. And people talk about this being like a distributed ledger. But I think this is a globally distributed Ponzi scheme. Normally there's one guy at the top of the Ponzi scheme doing all the work. Here you have thousands of different Twitter personalities all pumping the thing forward. It's actually a great Ponzi scheme. In the end, there's a pretty thin float, and there's this vehicle called Grayscale Bitcoin Trust that keeps buying all the free floats. And You have the true believers that never sell. You have Satoshi that hasn't sold. You have a pretty narrow float, somewhere between 6 and 8 million coins. And Grayscale has about 500,000 of them now and keeps adding a few thousand every day. And at some point, they're going to just corner the market in this thing. And once they corner the market, it takes not much incremental buying to push it up. And once you get above, let's call it 20,000, I think FOMO takes over and all the retail guys come in. I mean, you just saw PayPal build you a conduit that you don't have to go to Coinbase. You don't have to open a separate account to buy some coins. You just, throw it through your PayPal account. Square has done the same thing. You only have MicroStrategy or Square. They're also buying it. I'm pretty sure that maybe not Q3, but definitely by Q4, you'll see some other large tech stocks report that they own Bitcoin as well. So you have this sort of thing where there's not much of a float, and there's a lot of guys consuming this float, and eventually it's just an old-fashioned squeeze higher, and it feels very inevitable to me. I know a whole lot of Bitcoin through Grayscale. There's about 20 of these vehicles publicly that are, every country has one or two of these, and they're all buying Bitcoin every day because money comes in, and unlike an ETF where you can take your money back out if it trades below NAV. These are permanent vehicles, so once the Bitcoins are bought, they never leave again. So once I understood the mechanics of how this worked, I kind of said, I know this thing is absolutely functionally worthless, but I like a good old Ponzi scheme too. So I'm long, and I've been long since about 9,000. It's been good to me.
Yeah, no, it's not. Hey, what are we trading at today? I think it was at just over 13 or
13.8 right now. 13.7.
Oh, it's had another little run today. Oh, there we go. All right. Well, hey, Bitcoin.
I think it goes a whole lot higher because it still has that kind of like scarcity value thing, and in theory, it's good if inflation goes up, and I think inflation goes up, and it seems to do well with geopolitical volatility. I'm sure we'll have some more of that. I think it just plays into a lot of social and macro trends right now. But in the end, it's just a Ponzi scheme.
For sure. All right. Well, now we're at my favorite question that I love to ask all my guests on here. So, Kuppy, what would you say is an investing experience that impacted you the most thus far in your career?
The most? I don't know. You mean like having a big win or
big win, big loss, learn the most from, all the above?
Well, let me give you one I learned a lot from, because I haven't talked about this. And, there was a company, South Health, I don't remember what it's called. But I used to do a lot of these block trading stuff where I had a bunch of these brokers. They'd call me up, be like, "Hey, Kuppy, we're going to print 1 million shares, $2 in the hole. Do you want to take 50,000?" I'd be like, "Yeah, sure, I'll take it." And then, 2 days later, it bounced 50 cents, you sell it, or it bounced $1. Because, they've had these blocks they had to get rid of. And, nowadays, a big institutional investor, a pension fund, whatever, they want to move a few million shares. They put it in the VWAP machine, it kind of goes away. Back then, these guys would just say, "Okay, what price can we price it at?" So I bought a bunch of these blocks. And every single time it worked, so I started playing it bigger. And I got into this thing called Health South, and it was down quite a lot. And there's this big block, and my guy calls me up, and I go, "Yeah, I'll take a bunch." And I took too much. I took way too much, actually. And about 10 minutes after the block cleared, it came on TV that the feds had raided them. It ended up being a fraud. It went bankrupt. And the stock was halted. And it was kind of terrifying because I was playing these things really big because you're only picking up 50 cents or $1. And I started looking at where it was indicated pre-market, and I was basically bankrupt, which is one of those things you're not supposed to do in this business. The whole point is not to go broke. I was like 20. This is before I had my hedge fund, so I was like 19 or 20. But it was kind of a scary thing. Like I'd worked for a couple of years and built up a grub stake, and you can lose it all one day. And thankfully the thing opened and went straight up, and I blew out of it. It was a pretty big loss, but I was able to recover pretty fast. And I said to myself, I'm going to actually have position limits going forward because the whole point of this game is not to blow up. It's kind of one of those learning things that thankfully I did when I was 20 as opposed to 19, whatever it was, as opposed to doing now, at my age, because I don't want to get broke. So, it's just one of those things that I think everyone in their career has to do once, where they have one of these like, oh shit moments. and then realized that, hey, let's tone down the position size. Let's live to fight another day. Like, I don't care how bullish you are. Like, you can't just go all in. I see a lot of people being like, yeah, I went all in on this one. It's like, really? Like, no, you're not supposed to go all in. Like, that's the whole point. You're supposed to have some reserves, so if it drops, you can average down, or, it's one of those things I think everyone has to screw up once in their career. So I figured I'd toss that one across, because I'm sure you have a bunch of listeners who, are probably gonna make the same mistake I did. And thankfully the thing, I remember it was like $40 stock. It's indicated like $15, and I was like, oh my god, broke. And then it opened at like 25 and kind of traded up to low 30s, and I just got out of it that day. And then it basically rolled over and went bankrupt over the next year. But it's one of those super scary moments.
Oh, I can imagine. I mean, have you had any oh shit moments since? Maybe in the last couple of years that you've been like, oh, that's different.
This is the closest oh shit moment. It wasn't even my moment. It was a very good friend of mine. When Kodak had the supernova, right? It was last month. It went from like $2 to 60. So a buddy of mine, he has a decent sized fund, and he was short some Kodak. I literally don't even think it was his position. He had his analyst put on like 50 or 100 bips. Let's call it 100 bips of 20 dying tech stocks. It was just kind of like a beta hedge for his long book. So he didn't even put any effort into it. It was like, I'll take some Kodak, I'll do some of this, I'll do some of that. He's like, yeah, let's do 100 bips each. $2 stock. And they announced this pharma thing. It got to $8, and my guy, so it goes from 100 bips to, let's call it 400 bips. And my guy's like, okay, let's sell 200 bips more. So now it's like at $8, it's like, it's just 400 bips, it's 700 bips now, or whatever. And, the next day it goes to 60, and my buddy, he's just like, what do I do? What do I do? And I'm like, what can you do? It's halted up limit. And he called me, he's like, what do I do? I'm sure, 500,000 shares or whatever. I'm like, what can you do? It's halted up limit again. Like, you just asked me what to do, and it's just put another $5. Like, there's nothing you can do. And, I had that same, your heart seizes up, but for my friend, because it just keeps going up limit, and it has like 12 consecutive halts. And even if he tried to buy 500,000 shares, he wouldn't be able to, because he would just push it up limit again. And eventually some sellers showed up, and the stock came from 60 down to like 25 or something. And he had a really large loss for his fund, but he'll live to fight another day. And I hope you learned a lesson. I mean, the lesson is don't short stocks, because on the long side, you can trade at any price, and as long as you don't have too much margin on, you'll just average down. But on the short side, a $2 stock can go to 60 on no news, really. And that's just terrifying that a 100 bips position can, take down a couple $100 million fund. So anyway, you asked me if I've seen that again, and thankfully it wasn't me. He's asking, what do I do? And I said, I have no idea what to do. Like, no one knows.
I feel like that's what makes it an oh shit moment. It's just like, oh shit. Because you're just at a loss. You see it happening, you're like,
but it's not even that you're at a loss to see it happening. It's that, it just gaps up $5 on like 20,000 shares, and it's frozen again. And it's like this, 10-minute circuit breaker, 15-minute, and you're kind of like, oh shit, what do I do? And then before you can even do anything, it's up another $5. Like, and anything you do just forces it up limit more. Like, you just make your own problem. And what you have to do really is just sit there and hope your margin clerk doesn't notice. And it gives you time to hope the stock drops. But I mean, it's terrifying to think that a $2 stock can go to 60, and that's why I keep telling people to stop shorting.
Yeah. No, for sure. Well, that actually leads into my next question. What advice would you have for new investors, or just any investor who's listening to this right now that's looking to either enter the market or just in general? What advice do you have in the current state of the market right now?
I mean, the current state of the market is really odd in that you have this huge bifurcation. You have anything that's in an ETF that's gone to outer space, then you have all these companies that are ridiculously cheap. I mean, my portfolio trades at like 1, 2, and 3 times cash flow, and many of them are growing businesses. It makes no sense. I've never seen anything this cheap. You're mostly looking at C and D sort of businesses, but I mean, C's should still trade at some multiple. I would tell people to ignore the news, ignore TV, stay off Twitter. You just, all those things just play with your emotions and force you to trade. I would say go read some of the books, listen to the guys who everyone's forgotten about now, all the classic value investors. Everyone's laughing at them and saying they're buying the wrong stuff. And I think they'll be proven right in the end. And, I go to some of these value investing websites and just read everything written by successful investors and just absorb and learn. And don't be scared to go buy energy stocks after they're totally washed out. Don't be scared to go buy coal stocks or tankers or, just buy cheap stuff and ignore what's happening around you and you get paid eventually. That's what I would say.
That's a great way to end it right there. So, Kuppy, where can my audience go and find everything they need to know to follow you, get some more information about Praetorian Capital, as well as Adventures in Capitalism?
So if you sign up for my website, Adventures in Capitalism, I write articles whenever I get around to it. It's a free blog, so you get what you pay for. And it tends to be when I come home from dinner with my wife and sit down for another bottle of wine. And, what's the saying? Write drunk, edit sober. So, I just, whatever I post and, just sign up for the email alerts and you get them. In terms of my fund, it's Praetorian Capital. You can find me at praecap.com, but only go there if you're accredited.
Very good. All right. Well, with that, Kuppy, Harris Kupperman, thank you so much for joining me today. This was a lot of fun, and I'm sure we'll have you back on again at some point in the future.
Sounds great. Thanks for having me on.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.